Hi, I'm Norm Houle with Houle & Associates, Chartered Professional Accountants in Ottawa, where our mission is to allow people to live and enjoy a better life by saving time and money. We are presenting the Personal Pension Plan today, an excellent tax strategy for small business owners. With me I have guest Brian Haye, who's a financial advisor at CapCorp Financial Planning. I'll turn it over to him.
Thanks, Norm, and welcome to our viewers. It's my pleasure to introduce Jean-Pierre Laporte, CEO of INTEGRIS Pension Management, drawing on over a decade of experience as a pension lawyer for several prestigious Toronto firms, including Bennett Jones LLP, Baskin Martineau LLP, and Osler, Hoskin and Harcourt LLP. Jean-Pierre has dedicated his career to improving pension legislation. In 2007, he published an article in the Estate, Trust and Pension Law Journal titled Individual Pension Plans, Are They Worthy of a Second Look? And then by 2011, he had incorporated INTEGRIS Pension Management. He's often called upon as an expert witness before the House of Commons Standing Committee on Finance, and he has written several seminal articles on pension reform, including an expansion of the Canada Pension Plan. JP, thanks for taking some time to share with us your thoughts on the personal pension plan.
Well, thank you very much, gentlemen. And it's a pleasure to be here today to go over the personal pension plan as a concept for business owners, those that are incorporated and that wish to save a lot more for retirement than what is permissible under the other types of plans that we have out there, like the RRSP or the TFSA. So I would like to start by presenting three fundamental questions for the audience today. Now, can everyone see the screens correctly? Do you see the full screen?
Yeah, I can see it great, JP.
Perfect, excellent. Yes. Okay. So the three fundamental questions that we want to deal with today are, do I want to pay less tax than 98% of Canadians are using the RRSP to save for retirement? Is there a way to create more tax deductions than what is permitted by the RRSP system that everyone knows? The second one is, how can we maximize retirement income? How can we make sure that by the end of the projection period, we have significantly more money set aside for retirement than if we were using a product like a TFSA or an RRSP? And then finally, the last question that most people ask me is, can this be done in a way that I don't have to pay any fees, or that the tax savings generated by the system cover my fees and then even make me richer than when before I did this? Can this be self-financed? So the answer is, well, yeah, there is a way for all three of these questions, and it is the personal pension plan. So when people ask me, well, I've never heard of PPP, they say, what is it? So the legal answer, because Brian introduced me as a pension lawyer, that's exactly what I do. From a legal perspective, a personal pension plan is a retirement plan that is sponsored or held by your professional corporation, whether you're a doctor, dentist, or other types of professional. And it uses pre-tax dollars to fund your retirement savings. So, and what's great about it is that it allows you to contribute well above what's permitted by the RRSP rules. So every year we get to put more money than what is allowed under an RRSP. And that doesn't matter how old you are. Also, we're able to guarantee a 7.5% growth rate within your plan, because if you don't earn that kind of rate of return, the professional corporation is allowed to kick in extra money that we call special payments. And those are tax deductible to your business. So it's as if we're increasing the retirement savings space that's normally given to someone who has an RRSP. On top of that, all of the investment management fees relating to managing the assets are also tax deductible to the business, which is not allowed under an RRSP. And depending on whether or not the professional corporation paid you a salary or T4 income in previous years, we can retroactively recognize what's called past service and therefore allow our corporations to kick in even more money that's tax deductible to buy back these years of past service. Or if we retire early, there are additional corporate tax deductions that are permitted that we use the term terminal funding to talk about, and we'll get back to that later on. There's a bunch of slides on terminal funding, but that's just to give you a quick snapshot.
And I know everybody loves to save taxes.
Yeah, so just to wrap up sort of the more boring sort of legal aspect of the PPP. So legally, it's a combination, a registered pension plan that's governed by Section 147.1 of the Income Tax Act. Now, Section 147.1 is the same section that the Teachers Pension Plan of Ontario uses, that the GM Pension Plan uses. All the large, sophisticated institutional pension plans in Canada all rely on this section of the Income Tax Act. So we have the exact same rule that applies to our miniature personal pension plan. What's kind of different or exciting about the PPP is that it's built on three components. So we have a defined benefit component, and I'll get to that. There's a defined contribution component and an additional voluntary contributions component. So we have three buckets under one registration number. And the beauty of the PPP is that it allows you to switch between modes depending on a whole host of different situations. Sometimes you've got more money that you want to shelter. Sometimes you have family members that are young that would be penalized if they were forced to use the defined benefit component, so you put them in a defined contribution component where the limits are higher. Sometimes you've got money sitting in an RRSP where your investment manager is billing you fees for it, but you can't write them off. By rolling them into the third yellow account, the ABC account, now all of those investment management fees become tax deductible. So that's the basic architecture of the PPP from a legal perspective. And why this is important is because having this flexibility and being able to optimize contributions throughout your life means that you can put more money in a tax sheltered environment than any other account type permitted by the Income Tax Act. Now, we all know about the TFSA. Unfortunately, it has a low annual contribution limit, so it can never really, even if the rate of return is the same, it can never catch up in terms of wealth accumulated. The RRSP is better than the TFSA because it has a much higher limit, but it is capped. It doesn't really change except year by year. The individual pension plan, or IPP, is better than an RRSP, but only if you're between the ages of 40 and 71. So it doesn't help family members that might be participating in the plan that are below that age bracket. And also there are a number of other issues with IPPs, which I won't get into right now, but that make it less tax effective in terms of contributions. And the PPP, because it allows everything available under the rules, therefore gives us the largest accumulation of wealth over time. All else being equal, meaning that we're not taking additional market risk to achieve this result. It's purely a function of the tax rules that allow us to put more money in a tax-deferred basis. One quick note that I wanted to point out is that from a tax perspective, that's why we've got the word tax in red, the PPP offers yet another advantage, which is that since the corporation is making contributions to the PPP, and when I'm talking about contributions, I mean pre-tax dollars. So these are revenues that the company has earned and they haven't paid tax on them yet. So we use these pre-tax dollars and we contribute them to the PPP. That creates some additional beneficial consequences for us. One is that it protects any passive investments that would otherwise accumulate inside the professional corporation from the tax on passive investment that Mr. Morneau brought on a couple of years ago. And so that's great, because for those of you who've had a chance to talk with Norma about this, once you exceed $50,000 of passive income, the small business rate, the 12.2% corporate tax rate in Ontario, and the $500,000 allowance starts to be eaten away by the creation of additional passive income. So that's something that is to be avoided at all costs if possible, and the PPP allows for that. It also helps you if you want to purify your company should you decide to wish to sell the shares and you want to trigger the lifetime capital gains exemption. So let's get into the meat of the presentation, which is really a case study, because we found over the years that when people see facts and a case study, they can either see themselves in it or see other people they know that would be in it, and really appreciate all the different tax advantages that the PPP has to offer. So here we have a 45-year-old doctor has been earning 5% in his or her RRSP over the years. The Medicine Professional Corporation that employs the doctor pays T4 income at a rate of $150,000. Obviously, usually doctors make more than that, but some of it would go to expenses and others might be just dividends or just retained earnings. The corporation has been around since 2010. Up to this point in time, over the lifetime of the doctor's been able to accumulate $450,000 in RRSPs. This doctor would like to retire by age 65, so 20 years from now. And the corporation is paying tax in Ontario at 12.2% on the first $500,000 of taxable income. So I think that's a pretty standard case.
Yeah, I agree.
So the first thing that I want to talk about, because I like to cut to the chase, is like, we know that this doctor could load up on their RRSP every year, right? The question people ask me is, how much more can I contribute above and beyond what I'm already allowed to do if I max up my RRSP over that 20-year period? And the answer is $405,000 and change. So that's close to $500,000 more tax assistance that we've just created for you. The other thing too is that money is growing at 5%, right? Based on our projection. So that extra money is going to generate extra wealth, extra additional assets in retirement. In this particular case, that's another $680,000 and change. Again, that's over $500,000 of new wealth without taking any additional market risk. Right, Brian? We didn't pick risky stocks here to create that 5%. It's the same 5% rate of return based on the same asset allocation model that you would have used, whether they're in an RRSP or a PPP.
Absolutely, JP, yes.
Yeah, and so the third advantage is that given that we're able to contribute more and therefore claim more tax deductions, we are saving the company significantly more by way of taxes, right? We're creating real value here. So here we have at the bottom of the chart examples of how much by way of taxes that we've deferred by being able to contribute more to the PPP. This is not all the tax deductions. These are only the incremental, marginal, additional tax deductions that don't exist if you don't do a PPP.
Now, JP, sorry, if I can just jump in with a question here. I'm just wondering if you can, just before we move to the next slide, if you can take a second, just explain where this extra contribution room comes from. I mean, we're all used to RSP limits and it's a function of our income, but what is it that actually gives us this extra 405,000 of extra room?
Well, we thanks for that. We actually have a slide coming up, Brian, that breaks it down by categories. So awesome. We'll get into the minutia of where that 405 is decomposed into. So if you bear with me, we'll get there real quick. So this is just reiterating what we just said. if you're allowed to put more money, you're going to end up with additional money on top of what you could have earned in an RSP, which we'll have as well, right? This is just the marginal extra gravy that the PPP provides. Now, here's the slide that you're really asking for, is where does the 405 come from? Well, it breaks down into 4 different categories. So the first one is that, remember I told you that this doctor incorporated in 2010 and has been paying a salary of $150,000? Well, that allows us to do a past service buyback of those 11 years. And there's a cost to that, right? Because we're increasing the size of the pension that's available in retirement. So in this particular case, given the facts as they've been laid out, the corporation is allowed to do a $66,000, almost $67,000 corporate tax deduction to help purchase past service for that doctor. Then, because the pension rules are more generous than the RRSP rules when it comes to contributions on an annual basis, cumulatively, when we add up all these little chunks of extra contributions, we have $315,000 more than what's permissible by the RRSP system. Then, remember the yellow AVC account? That allows us to do additional personal tax deductible contributions. And in this case, over the 20-year period, from 45 to 65, this doctor is allowed to put almost $19,000 more in personal contributions, above the regular corporate contributions. And finally, because we artificially selected a 5% rate of return on assets, we could have picked 3%, we could have picked 7%, we picked 5%. We're not hitting the 7.5% rate that the CRA typically wants to see when you're trying to fund one of these types of pensions. And the difference between the 7.5% target and what we're actually earning creates underfunding inside the plan. And the law allows us to top up that deficit by throwing in more pre-tax dollars, which we call special payments. So when you add up all of these special types of contributions, that's where you get your $4,000 and $5,000 bonus. But there's more. There's more, because we're going to talk about other special deductions which come into play. One of them is the fact that the investment management fees are tax deductible. The second one is the terminal funding, which I alluded to. And finally, there's the phenomenon of being able to income split pension income well before age 65, something that you cannot do with a RIF, where you have to be 65 to split income with a spouse. We can do this as early as age 50. Actually, I have a 43-year-old Alberta client who is doing terminal funding and income splitting. So he's going to have years and years and years of being able to split that income with a spouse and save on taxes. So let's get into
saving taxes.
I know.
And just to add to that, JP, I mean, I have clients all the time who, you know, they decide to retire, say around age 60, but they do have to wait till 65 to do that splitting. So, I mean, the fact that they can do it earlier than 65, you know, that's huge.
Well, you'll see when we get to the slide that talks about pension income splitting, you'll see the amount of money that the couple is saving is incredible. So let's just start with the first one, which is being able to deduct more each year has an impact, because if we have to pay fees to INTEGRIS, right? And you can see in the table here that the total fees for over the 20-year period to my company to manage this plan in terms of the legal, actuarial, compliance, administration is $74,000, right? So you think, oh, I'm starting in the hole at $74,000 because I don't have to do that with an RRSP. But because we're able to write off all the investment management fees, we're able to generate a $36,000, and you can see that on this chart. A $38,000 credit, and this slide here gives you the background. So these are the assets of this doctor from age 45 to age 65. They're growing at 5%. And we've arbitrarily assumed that the investment manager is charging a 1% fee. So you can see what that works out in terms of corporate tax deduction. And again, we're using the worst case scenario that the company is only paying tax at 12.2%. So that gives you the taxes saved by the company thanks to the deductibility of the fees. So when you add up all the saved taxes, that's $38,511. So if you subtract that $38,000 from the $74,000 fee over the 20-year period, you end up with a balance of $36,000. So really the true cost shrinks to $36,000. But then remember that because we were able to contribute an extra $405,000, that's also triggering additional tax savings, in this case of $49,515. So the true cost of $36,000 minus the credit of $49,000 means that after paying Integris, the income tax refunds or savings to the company means that this plan actually costs nothing. It produces income. It produces $13,000 net in savings to the company. And that, a lot of people don't understand that because they say, what do you mean? What do you mean? This thing pays for itself and puts money in my pocket? How can that be? That's too good to be true.
And it's legal.
And it's legal. That's how the tax system works,
Yeah.
if you know what you're doing.
And Norm, I think this is the type of math you like, isn't it?
Yeah, exactly. It's like winning a lottery ticket.
Guaranteed without the odds. So again, just to go over this one more time, we've got fees, but because of the investment management fees, we've got a credit. So the true cost shrinks to about $1,800 a year. But once we've calculated the additional tax savings, we're actually in a positive territory. But so just to conclude on fees, this thing auto finances itself. But that's one thing, okay, sure, I don't have to pay and I'm getting, extra money in my pocket. That's great. I won a little bit of the lottery. It's like a little scratch ticket. But that's not the big picture. The big picture is on top of that, you're looking at $684,000 more by way of registered assets available for your retirement using the exact same rate of return assumption. That's the real winning. So, I mean, when people say, oh, JP, I don't have to pay you if I have an RRSP, I'm like, okay.
You're paying somebody.
Anyway, so that's one thing. That's the fee deductibility, which is a big component. The second one that I want to cover with you guys is, and with the audience, is of course the concept of terminal funding. So this table looks a little intimidating because it's covered in numbers, but terminal funding is a concept under pension law that says if you want to start drawing your pension sooner than the normal retirement age of, let's say, 65, normally you get a penalty because you're starting sooner. But terminal funding has been developed to bridge you into retirement with a higher pension to neutralize the penalty that you otherwise would suffer because you decide to turn on the pension sooner. So let's look at a concrete example. If you look at this table, this is for our doctor that's retiring at age 65. At age 65, this doctor is entitled to an annual pension from the plan of $166,760. And you can see that in the roll that says 2041 January 1st. But this doctor has told Brian or Norm, no, I want to turn on the pension sooner. I want to start at 62. So if that's the case, then instead of $166,000, this doctor is now entitled to $122,000. So there's a deep discount, right, in your standard of living. And that makes sense. But because terminal funding exists within the architecture of the PPP, we have the legal ability to take $530,000 from the corporation's pre-tax dollars and contribute them to the pension plan. So that's going to give the company over $500,000 write-off. And what it does is it provides the pension plan with more money, $500,000 more, to allow it to pay a higher early retirement pension starting at 62 of $163,909.
So JP, does that mean then if, let's say, the doctor or dentist had sold their practice, had a lump sum that was paid to them, they could actually take some of that money, use it for terminal funding, and then help fund the pension early for them?
That's exactly what I'm saying. You can neutralize the tax cost of getting assets coming in when let's say you're selling assets, like your client list, your material, your equipment, and the new doctor or dentist is buying the assets of your business. Of course, that would create, often with recognition of goodwill and others, that might create a tax problem for the company. We can neutralize that by having that money redirected into your PPP.
That's excellent.
Now, this $163,000, keep that in mind because it's going to come up again when we talk about the next advantage, which is the pension income splitting, which we've already kind of alluded to. So I said, okay, well, $163,000 is what this doctor is collecting at this age. That's fine. Now, in Ontario right now, if you just recognize that on your tax return, and Norm, you can correct me if I'm wrong, I'm using Ernst & Young's online calculator, you'd be paying about $52,000 in taxes.
That's right.
That's pretty right? Okay.
Yes, sir. Unfortunately.
So, okay. But thanks to the fact that the PPP is a true pension and you don't have to wait till 65 as per Brian's comment, well, now each person in the couple pays tax on half of it. So the couple as a whole, when you multiply what each person in the couple has to pay, pays tax of $34,648. So what have we done? Well, we've just saved this couple $17,000 annually in taxes every single year.
That's a nice trip.
Have to pay. What's that?
That's a nice annual trip.
Well, yeah, I've got a joke about that later on. So, and I've got a little banner at the bottom saying this is not bad, given that the most expensive version of the PPP is an annual cost of $3,300. That's like the Cadillac version of the PPP. We have cheaper versions, and Brian knows about those, but doesn't matter. Even if it was $4,000 a year, doesn't matter. So another way to look at it is the PPP income splitting rules just generate 17 grand per year for the couple in taxes saved. But there's a cost to having the PPP. So net, we got $14,000 in your bank account, which is my joke at the bottom is maybe it's a post-COVID vacation to the Caribbean every year, right? We work on our tan for the vitamin D. But the $3,300 is already covered because remember when we talked about the deductibility of the fees and all the extra tax deductions, that $3,000 is already covered.
Yep, that's right.
So just to wrap up, because I think Brian, you might have some questions for me as an advisor. What are some of the what are the results? You know, what have we done exactly for this particular doctor? Well, we've been able to create more wealth compared to just relying on the RRSP rules, even if we had maxed out the RRSP every year. The medical professional corporation or the professional corporation generally, if you're a dentist or just a business owner, saves substantially more tax. And remember, that's one of your big assets. It's your money. And then the income splitting has provided significant additional tax savings. The net 14 grand a year gift from INTEGRIS, plus the fact that the tax refunds have paid for them, have paid for the fees anyway. It's not coming out of your pocket. But if that wasn't enough, on top of that, because this is a pension plan, we provide the highest level of credit protection in Canada. It's more secure than an RRSP. And when it comes to investments, we have superior investment options because we're not restricted to the RRSP eligible asset classes. We can go above that to do what the large, sophisticated pension plans in Canada have been doing for decades. And if that wasn't enough, our company, INTEGRIS, provides fiduciary oversight through our team of pension lawyers. So I'm a pension lawyer. We have 3 other pension lawyers here at INTEGRIS whose job it is to supervise these plans, protect the client from CRA, from the provincial regulators, and supervise the actuaries and all the other players that make sure that the plan is followed. Something that you don't have with an IPP or an RRSP, to be honest. So just to wrap up, we go back to our 3 questions. Do I want to save less tax? Do I want to pay less tax than 98% of Canadians? Most people would say yes. I certainly would.
Oh yeah.
Do I want to maximize my retirement? Do I want the $680,000 extra for no extra market risk? I'll take it. And would I like the program to be self-funded by the tax savings and the refund so I don't have to shell out any money out of my pocket? Yeah, if I can, yeah. So that's pretty much the basic parameters of the PPP, and that's pretty much all I wanted to say today in terms of my formal remarks.
Okay, well, thank you, JP. That was very educational.
Thank you.
Yeah, that was great, JP. Very, very good. And yeah, if you don't mind, I do have a few questions actually that often come up when talking about PPPs and the advantage of using them. And I guess the first one relates back to one of your earlier slides, which had a pie chart, and it showed DB, or defined benefit contribution, DC, defined contribution, and then also the third one, this AVC, or additional voluntary contribution. And that's what I want to ask about, because I've been an advisor for 20 years now, and we've never been allowed to deduct fees in an RRSP. If it was allowed, clients could have saved a lot of money over the years. So are you saying then that the AVC component of the PPP means I can do that? That by holding my RRSP in the PPP, that I can now deduct my investment management fees in my RRSP?
Yeah, well, so what happens is this. Under paragraph 18(1)(u) of the Income Tax Act, you cannot write off the investment management fees in your RRSP. And that's the rule you were saying for the last 20 years. Under a pension plan, monies inside the pension plan where you have investment management fees, those are an expense to the company under paragraph 18(1)(a) of the Income Tax Act. Therefore, when you transfer your RRSPs on a tax-free basis, and we do this thanks to a CRA form T2033, when you transfer your RRSPs into the AVC account, they cease to be RRSPs. They're now considered pension monies. So any investment management fees that are levied on those assets become tax deductions to the business under paragraph 18(1)(a). So that's the legal explanation why this is the way it is.
Okay, awesome. And then just follow up with that. So you said, so I moved from RRSP into AVC. Can I then move it back out again at any time, or do I have to wait for the pension plan to be wrapped up?
No, you could, if you really needed access to those AVC dollars, we could file a plan amendment to remove the AVC provisions of the plan, to take this yellow account out of the picture. That would free up your RRSPs and your AVC money, sorry, and then you'd be able to roll them on a tax-free basis using a different form called a T2151. You'd be able to roll those RRSPs back into those ex-RRSP assets back into an RRSP. So the answer is yes.
Awesome. Okay, so it's flexible then.
Yep.
I love it. As an advisor and as a client, I love it. All right, so another question was, who can be added to the pension plan? We've certainly focused on the business owner, but can key employees or other family members be added? And then if so, how would they get added?
So yeah, the answer is yes, But the legal test is you have to be paying these people T4 income from the company that's sponsoring the plan. So kids that are not employed can't help them. But if they're on the payroll, even if it's part-time salary, low clerical job, they would qualify to be added to the plan. And the reason why adding family members to the plan is extremely tax efficient is because if the primary plan member, maybe in their 60s or 70s, passes away, let's say they don't have a spouse, so you can't do a rollover to a spouse, they pass away, all the money is sitting in the defined benefit component of the plan, instead of being subjected to a deemed disposition, the way RRSP monies would be, TFSA monies, or RIF monies, instead of having a deemed disposition, none of it gets taxed inside the defined benefit account. So the children that are also plan participants end up with this windfall. They get their parents' money, no tax, and no probate provincially either, by the way.
Wow,
now,
that's great.
What they do with that surplus, it's up to them. They can leave it there and keep growing it until they need it. Maybe 20 years later, they'll need it. They can withdraw some of the surplus. Of course, that's taxable in their hands, but only in the portion that you pulled out. Or if the company has losses, tax losses, you could transfer some of that surplus back to the corporation and use the tax losses to net out the tax gains. So there are multiple things you can do with that surplus that's left behind by the deceased plan member. But to me, I would rather leave $2 million of surplus to the children instead of cutting a check to the government.
For half.
That's it.
If the law allows it, which it does.
Yeah, that's great.
Awesome.
Now, you were asked, Brian, you were also asking about other kinds of employees.
Yeah.
You can, although, because if these employees are non-shareholders, non-connected persons, the funding rules get a lot tighter. And in that case, it might become an expensive proposition. So maybe for your top executives that are key to the company, that you need to put golden handcuffs, to keep them, then you may want to incur the ability to contribute more, and just don't pay them as much bonus. Just transfer that money into their pension plan. But for the rank and file, we really don't see it happening because it is such a rich plan that most employers would rather pay themselves more dividends than give it to their employees in the form of a pension plan.
Got it. All right. Great. Thank you. Okay. So then what if I sell my business? I mean, does this pension plan have to be cashed in, or, what are my options?
Yeah. So if you're doing an asset deal and you're selling all the assets of your professional corporation or your normal corporation, then the company continues to exist. Therefore, it can continue to sponsor the pension plan. So you don't have to wind up the plan at all. If you are doing a share deal, because maybe you want to trigger the lifetime capital gains exemption and you need to get the passive assets out, PPP is great for that. We talked about past service. We talked about terminal funding, hundreds of thousands of dollars of corporate tax deductions to help purify. So if you do a share deal, the new shareholder that's taking over the business most likely will not want to sponsor the plan. So you have to move it out of the company. And one way is to transfer responsibility to the plan to a new company, a new employer that you've set up for yourself that will become the new sponsor. And that transfer is done on a tax-free basis. And the new company takes over the pension plan from the company that's being sold. So the purchaser of the shares doesn't have to worry about the pension plan because it's been assigned away pre-closing. Now,
Okay.
if you can't do that, there might be situations where clients say, I want to sell the shares and I don't want to continue with another numbered company or a new consulting company or whatever. I just want to shut everything down. I want to move to Florida or wherever, Colorado or California. Then what do? Well, you can wind up the plan. So if you wind up the plan, you can transfer the assets to an RRSP or a RIF. In the old days, it had to go to a LIRA, a locked-in retirement account, or a life income fund. But since December the 8th of last year, the PPPs don't have to do that anymore. They can go back to an RRSP or a RIF, depending on your age. And if you don't want to do that, you can always go and purchase an annuity from a life insurance company that will pay you a pension. So lots of options.
All right.
Good to know.
Yeah,
and this pension doesn't show up on the balance sheet of the corporation, right? It's off books, so to speak.
Yeah, that's right. So no problem with the tax on passive investments. It's not going to trip you up when you're trying to realize the qualified small business rules for the lifetime capital gains exemption.
Okay.
Yep.
Wow. Nice. Where do we sign up? Oh, I did.
How many years ago, Norm?
I'm going on my 3rd year now, and highly recommend it to our clients.
Brian, any more questions?
Yeah, actually, there's 2 more. And so of them, so can I combine the PPP with like corporate-owned whole life insurance policy and other investments inside the corporation?
Yes, of course. So there are 2 ways. One is to have both strategies going at the same time. So of course, if you, let's say you prepay your corporate taxes, but now because you're making contributions to the pension plan, CRA refunds you a lot of these corporate taxes. Those tax refunds can now be used as premiums to go and buy whole life or universal life or permanent life insurance policies. So then you got belts and suspenders, right? But you didn't have to pull out money out of your own pocket. You're just getting your own tax money back from the government at the corporate level and using that as the premium. So that's one approach. The second approach is the pension plan itself could use a permanent life insurance policy as the vehicle by which you're investing for retirement. So for the listeners who may not be as familiar with permanent life insurance, there's usually 2 components to it, a death benefit and an investment account. So the death benefit could be a couple $1 million, and then the investment account is just monies that are investing tax sheltered within the policy. And well, what happens is if you were to pass away, the death benefit could be payable to the pension plan. Now that would be taxable. So what would otherwise be non-taxable becomes taxable, or it could be paid to a third party outside the pension plan, like a family trust or some other entity, or a charity of your choice, someone that's tax exempt in the first place. So there's this ability to split the value of the permanent life insurance policy into different beneficiaries, one being the pension plan, let's say the spouse that survived, or the children, and the other being either the plan itself or some third party. So yeah, so for those who are big fans of permanent life insurance policy, that's yet another application where it can work synergistically with the PPP.
Okay, great. And so then, JP, just one last question. Why doesn't everybody do this?
Well, that one I have to turn back on you. And Norm, how come all your clients haven't signed up yet?
Well, partly for fear of being locked in and committed, because of the word pension, I think is scary to them. Just like a whole life insurance policy with its fixed premiums every year. But once we do some cash flow analysis with our clients, cost benefit analysis as well, yeah, most of them are ready to sign on. So I'm anxious to introduce them to this concept and sign them up.
No, that's great. So I guess if there are no further questions, we can probably wrap up.
Okay.
Thank you. That's it for me too.
Okay. Well, thanks everyone. And if you have any questions, Brian, of course, is available to field those technical investment questions, and Norm, all the tax questions. And if there are pension legal, I'm sure they'll contact me to be able to answer those for you.
Thanks very much, JP.
Bye-bye, everyone.
Thank you, Brian and JP.